Okay, welcome back to the EIA Inventories now with your host Tony, as always from MacOS. Just make sure that you guys can hear me all right. Hope the sound is still good. Hey, hello FX Bears. Hello, welcome back indeed. Thank you very much. And Scotch and Stocks, I think you're still on there. I can see some of your messages from earlier saying that now we play the waiting game. FX Bear says, yes, sir. Yes, sir, indeed. EIA Inventories is going to be a bit more interesting, I think, this week, as it was last week. As always, we have quite a bit of sentiment to go through, and we'll get through that with you now. So the EIA inventories then. So what is it? So what it is, it represents the weekly change in crude, gas, and distilled inventories. So the areas that are most affected in the economy are transportation, and also can affect consumer prices for a number of products as well. So don't forget, of course, a lot of products are made using oil or crude oil with plastics. So just to bear that in mind. So transportation being the main key thing that's affected, and that can affect the CPI report in the US as well. So why is it a release to watch? Well, the main reason being is because it can be a very volatile trade. Whereas last week we saw where we had a deviation of quite a large deviation of about 8 million compared to the forecast figure. We'd seen about $1.32 move towards the downside when there was that huge build in crude oil inventories, a much bigger build compared to the other draws that we had in gasoline and distillate. So that's why it can be a very volatile trade, and one release to be aware of and to watch. So how does it affect the markets? So again, the key thing to make sure and to understand, I think there's some questions that I had received in an email as to why crude, if it goes up, why it isn't that a good thing. But the main reason, so what I want to clarify is, again, so when more oil is added to the market, usually less demand there is less demand for it. What happens is that when there is less demand for that build in inventories, then that will cause crude oil prices to see a movement towards the downside or a depreciation, particularly in the short term. Okay, that's what we're focused on, is the short-term reaction, where in the crude market, a bigger build is worse for crude oil. And when there's less oil added, or when there is a draw, usually that is a positive oil. Of course, the less oil that there is, then usually what that denotes is that there is high demand. So of course, to ensure that the demand doesn't outweigh the supply that there is available, prices are usually raised in order to make sure that the suppliers of crude and of oil have enough to be able to supply to the market. Now for the EIA inventories, again, it's more of a short-term reaction, where specifically traders are more focused on how big of a build or draw that there is within the EIA inventories. But again, even though of course it's on a shorter time scale, the more oil that is added, and historically what we've seen as well in the past, it's negative for oil, and less oil added, or when there's a draw, then it is more positive for crude oil prices. Burr says the more exclusive oil becomes, the higher the price. Exactly. The higher the demand is and the less supply that there is of crude oil, the higher the price can go. Okay, so carrying on. So the triggers then. So we've got part economist triggers, and then some of it are some of our triggers too, and what we'd expect from the past reactions, what we've seen with crude oil inventories data or EIA inventories data. So according to economists, they're looking at around 5 million as a high estimate, with a low of 2 million. And gasoline, there was a high of gasoline. They're looking for a high of 3 million, with a low of -2 million. And still, they're looking for a high with a high estimate of 3 million, with a low of -2.5 million. Then, one thing that we always keep an eye on, and traders have a focus on, hence it's here, is the API data. Now, the API data it is private data that's released the night before we get the official data from the Energy Information Agency or the EIA. And sometimes there can be a reaction to that release when there is a big deviation in the forecast figure compared to when there is a big deviation in the actual figure compared to the forecast figure. And sometimes that data can have a correlation to what the data the following day might actually be. So if there was, let's say, a build in inventories in the private API data, then what that could mean is that there might be a build in the inventories the day after in the EIA inventories report, or the official government report. That doesn't always happen though, as we've seen in the past, where it's not been so reliable to as a gauge of what to expect for what the data will present the following day. But saying that, it has had at some points in the past where it has been correlated quite well, and we have seen a similar reaction in the or near enough similar, the same direction, let's say, for whether it's a build or whether it's a draw overall. So that's why we look at it and take it into account, and for our expectations. Again, it also adds to sentiment as well. So sentiment wise, if you have crude oil the night before, or crude data that was, let's say in this case, it was more of a draw compared to the forecast of 2.533 million when the price was 7.757 million. The actual came out at a draw at -4.496 million. Usually what happens, again, we could expect yesterday there wasn't a reaction to the release, even though there was a huge draw compared to the forecast figure. So could we get a similar reaction today with EIA inventories? We could do, where we could see a further draw, or we could see the same direction. But again, as said, the movement isn't always correlated so well, but it is still a release that people and traders keep an eye out for. So for gasoline, gasoline stock change, the actual was 2.933 million compared to the prior of -5.053 million. And then distillate stocks change was -1.652 million with a prior of -4.961 million. Nitesh Khanna says last week the impact was the opposite. If just so I'm understanding what you're saying, if you're saying that the rest of the EIA inventories data was a draw, i.e. there was less oil added, you're trying to say that that was why there was an opposite reaction? That was why there was an opposite reaction, if I'm correct in saying that? If that's what you're saying, well, you've also got to bear in mind that the overall figure for crude oil was much bigger in difference-wise compared to if you combine gas and distillate altogether, that's about 5 million. That's about 5 million in figures, whereas the crude oil had a deviation of 8 million. So it outweighed or outstripped the other two figures, if that makes sense. Hence, you'd seen a decline in WTI crude oil of about $1.32. That makes sense? We'll get to you in a little bit. Okay, so going ahead then, if we want to, again, so on the market reaction, as April 6th, we had seen WTI crude oil weaken, but not by too much. But April 13th, as I said last week, we'd seen about $1.30 move towards the downside. So let's have a look at the deviations then of what we've seen in the past. As I've already stated, with the crude oil data that we had last week, we'd seen about 8.3 million deviation from the forecast, which was much bigger than our usual deviation. So during the Ukraine-Russia conflict that we had, that we still have, and towards the beginning of that, we were looking for about at least 5 million. But even then, with that data, or at least 5 million deviation, we didn't see market reaction, mainly because market didn't care about how many oil inventories were added. They're more concerned with how the Ukraine-Russia conflict was developing. Okay, and it's a new shock to the markets at that point in February. So that was outstripped. So the EIA Inventories releases, again, as stated in the prior report or prep that I did, it became meaningless. Okay, sentiment overtook the report. But last week we had seen much more. We had seen much more of a move in inventories. Now that the effects of, now that the commentary that's coming through about Russia and Ukraine, about peace talks being at a dead end, or that they're going to be, that high-level talks haven't occurred in recent weeks, according to Ukraine's Kuleba, or their foreign minister. We're not seeing too much of a reaction to those headlines. So in a way, the markets have become desensitized to the headlines that are coming through about Russia and Ukraine, to the point now where the releases such as WTI crude oil, such as EIA Inventories, are having more of an effect, as they normally would do when we get the EIA Inventories data. So there is a bit, so the correlation between the Ukraine-Russia conflict sentiment is depleting from what we've seen recently as well, not just in WTI crude oil, but in other areas such as in stocks or the US indexes and other indexes or stock indexes as well, and currencies and gold are not seeing too much of a reaction to the headlines. So overall, the markets are going back to a norm where they're not so volatile, or not reacting so in such a volatile way to the news. So if you have the economists that are looking for about 3 million, about 2 million deviation in the headline crude oil inventories data, I think from the past data that we've seen here, where we've seen about 5 million deviation with 42 ticks towards the downside, and about 8 million deviation, where we've seen about $1.32 ticks towards the downside. I think we're looking for more so within more within that range. So I think at least according to, as I said, according to economists, about 2 million, but I think we're looking for at least a 3 million deviation to try and get a stronger reaction from WTI crude oil. As said, we had seen crude oil last week see about $1.32 towards the downside from an 8 million deviation. But bearing in mind, you had the other two figures that had a draw. So the effects of the release were, yes, there was a bigger reaction, but it wasn't sustained, as we'd seen that the release, as we'd seen WTI reverse that initial move towards the downside. So usually what happens is that if the headline figure comes in line, or is as much better, or is much bigger or smaller than expected, and we get at least a 3 million deviation, then you will look for the other two figures, such as with gasoline and distillate, to support that, to have an even bigger move in WTI crude oil. Or, so that's one scenario. you will look for all 3 bits of data showing, let's say, for instance, here a build today, let's say, or a draw. The second scenario is where you have 1 bit of data that is bigger than all the other bits of data put together. So you could still see whether it's, if there was a draw, then you could potentially see a move towards the upside or an appreciation for crude oil, for WTI. But and then vice versa, if you see a build, then you could see a depreciation in WTI prices if it's bigger than the other 2 figures overall. Now, the harder release or reaction to the markets would be where the data is more or less in line with expectation. Okay, when I say that, is when, again, there isn't too much of a deviation from the forecast figure, and it means that the release can be, or sometimes it means that there isn't too much of a reaction to the release. So that's one scenario. That's the other scenario to be aware of. And of course, the final scenario is that if the, let's say, 1 figure is a build, or the crude figure is a build, and the other 2 figures are a bigger draw, then what that could mean is that actually, yes, we could see an initial move towards the downside in WTI, but if the overall sentiment is that there is a bigger draw compared to the figure that had a build, then, or the headline figure that had a build, then you could see an appreciation in WTI crude oil. So there are those scenarios there to be aware of. And I think let's go back to our bit of prep, but let's have a little look. Okay, sentiment. And I will try and go through the market reaction. We got about 13 minutes till the release. So yes, sentiment. So you have hedge funds that dumped bullish positions on Brent oil futures for 3rd straight week. This is data on Friday, according to the latest data available from ICE Futures Europe. Money managers sold a net 3,227 futures contracts in the week ended April 12th, trimming the total to the lowest level since November 2022. And I think today as well, even today, we're down about nearly 2% on WTI crude oil. Libya, they had an issue as well where it had actually supported crude oil prices and had seen an appreciation, or a slight appreciation, where Libya's 530,000 barrel per day oil shutdown occurred due to protest in the wake of unhappiness with how the government is being run. So oil prices partly climbed early Monday. The news happened on the news came out on the Sunday over the weekend, but as of yesterday, so production of Libyan oil is at 800,000 versus 1.3 million. So about a 500,000 loss in oil production, which again, as said, the less oil that there is available, the higher the demand usually is. That usually supports oil prices. So that's what occurred in the markets, where the markets were unsure whether or not, or how badly the Libya shutdown would affect oil prices. So we had seen some, as seen earlier, I said earlier, part climb in WTI prices. Natural gas prices as well, just in regards to focusing on what energy is doing and how that's affected the market overall. They hit $8 for the first time since 2008 due to high demand during a longer winter. European ban on Russian oil. So you have the US and UK that moved to bar Russian oil, which in turn you had the Germans who actually recently said, if I bring this up, you had Germany's Lindner who made some comments earlier on, if I can find it. Yeah, so Germany's Finance Minister Lindner said that we can end our dependence on Russian coal and oil faster than we can with gas. So just to bear that in mind, so Germany, of course, receives quite a bit of their energy from Russia, as does Europe. And I've stated it before, but Russia makes up about nearly 30% or 36% of consumption of liquid natural gas in Europe, or the consumption of that. So withdrawing the supply from Russia would be a very heavy blow to Europe itself, where you'd see prices skyrocketing. But that's one thing. I guess one of the things that had been mentioned was that oil could be, or the Russian oil could be replaced within 4 months, which seems quite optimistic. But as one of the things that's been stated. So again, is whether or not that ban is going to happen in Europe. That's causing some whipsawing and volatility in the commodity space. So the other bits of data and news as well as sentiment. So you have China concerns, Shanghai. So recently, and only recently, have they started to ease the lockdowns in Shanghai, which of course, when you have locked people, or a city, particularly Shanghai, in China, where it's more of an industrial place, then, or industrial city, then you would expect crude oil prices to see a bit of a rise due to demand coming back from China. But we're not completely out of the lockdowns yet. So, but it is, for sentiment wise, can have a positive, is having more of a positive effect on crude oil. Also, other bits of news as well in regards to looking at other areas for crude. You have a cargo of crude from the US, Special Petroleum Reserve, departed a Texas port bound for Europe, a signal of increasing oil market disarray as refiners shun Russian supplies and prices surge. We have OPEC as well with a monthly report, who say that surging energy from conflict will take a heavy toll on global economy and weigh on demand. And they see economic growth at 3.9% from 4.2% due to high commodity prices. Russian oil production is forecast reduced by 530,000 barrels per day to 10.8 million barrels per day, compared to 10.59. And then you also had, as said, so this is just a reiteration of what's been said before as well. And then you had some other bits of news with OPEC telling the EU the Russia oil crisis is beyond its control. So you don't have OPEC looking to support Europe, even though it's looking to be in dire straits at the moment without their Russian supply, or the complications of trying to withdraw the Russian supply. Okay. Also, as said, money managers less bullish, and they trim their net long wages on Brent oil rally to a 17-month low, just something that's been touted and shown before as well. That you can see that the conflict where you had in February, seen that rise in bullish positions or buying of crude oil or WTI crude oil, and then of course now with the sentiment depleting, or near enough not having too much of an effect on the markets, and the less uncertainty. Again, key thing is the uncertainty. There is more certainty as to what's going on. The markets are returning to normal. Again, of course, you have the uncertainty of the Ukraine war itself. What I'm talking about is the way that traders react within the markets when there's uncertainty. So if there's uncertainty or high levels of uncertainty, there's a risk of reaction where traders will go into safe haven assets, and we've seen WTI crude oil prices soaring. But now that traders have gotten used to it or have become desensitized to the news, there is less uncertainty in the markets. If that makes sense to you guys. That's when I say uncertainty in the markets. That's what I mean. Okay, if we go to our next bit of bit here. So you have ING. So that clearly, this is in regards to China, that clearly the regional lockdowns are lasting longer than many expected, and this will have a greater impact on oil consumption in the immediate run. And this weaker demand helps to alleviate market tightness that we are now experiencing. And then you had JP Morgan saying that an immediate EU embargo on Russian oil might send prices rising, but a more gradual phase out would have little effect on pricing. Then we have this point of this bit here from Bloomberg talking about oil shipping costs from Russia and Baltic ports have surged, so rates spiking. Again, crude oil price, the transportation of crude oil from Russia is being affected the most. And as we've seen in other CPI reports, and today with the Canadian inflation report, we'd seen that transportation was a very big part of the reason why we'd seen a higher than expected actual figure from the CPI release in the month and the year on year as well. Okay, got about 4 minutes. Let me grab some of the videos. Okay. Yeah, there we go. Okay, so I don't know if you can see that clearly, but again, there was a bigger build than expected. So hence we'd seen a bigger reaction from WTI crude oil there. And again, as said, there was about $1.32 move towards the downside. So also keeping an eye on tick strike 2, where we'd seen that tick strike was showing that there was still some further depreciation or more selling that was going on with the with WTI crude oil or crude oil futures. So if we then kind of skip ahead a little bit more, we'll kind of see how that actually reversed quite quickly. Well, it didn't sustain its move. So again, there was a big build overall, but you had the other two bits of data that have shown that there was a decline. Okay, we've got less than a minute. Ooh, let's go back. About 10 seconds. There we go. Okay, let's keep an eye on this here. Okay. All right, so that's a draw there of minus 8.020 million compared to the forecast of 3 million. So that's at least a 5 million deviation there from the forecast figure. And also distillate inventories coming in as a draw as well, minus 2.664 million compared to the forecast of minus 0.8 million. And then a build in gasoline inventories. Overall, a much better report where you've got two bits of data supporting each other now. Okay, so that looks like quite a nice move on the EIA inventories. Okay, so all right, that's the reaction there. So let's have a little look here. See. All right, so that's $1.27. What we see there. Dollar was in 127 ticks. Okay. So deviation wise, what we're looking at. Okay. Well, okay, so that was about 11 million deviation compared to the forecast figure. That's just on crude. That's just on crude. If we're looking at gasoline, yeah, so gasoline. And then okay, so here's our deviation then overall. So again, as said, 11 million deviation on the headline figure, and then we had about 0.3, about 300k deviation from gasoline, and then distillate about 1 million or 1.9 million deviation from the forecast. So overall, a bigger draw in the report itself. We've seen about 127 ticks towards the upside for that release there that we had. Okay, so we had some questions. Scotch and Stocks says, are we... I think that was just before the release. FX Burr said, Tony, do you not place trades during news releases? So I think the key thing is being able to give you guys the preparation needed, and that kind of takes time. So in order to be able to do that, that's why I think at the moment with trading releases isn't what we're doing at the moment. The key thing is giving you information and sentiment. So the higher quality the information that we can give you, the much better that there is that we can do to provide that service for you. But I guess in the future, I think let's say if there is someone else who's also running this as well, maybe. But again, that's a big maybe. But again, more so preparing you for the release with quality information, and that requires a bit more time and focus on the macro aspect and sentiment aspect to find those bits of news for you and put it together in a better way. Okay, so still seeing some moves. Well, still hasn't retraced, hasn't moved back or as quickly back towards the downside or below pre-release levels. So that's about, I said 127 ticks towards the upside. Okay. Scotch and Stocks says, why is the price? Okay, so why is the price? You kind of leave me half there. You got to give me something else. Saying why is the price up? Is that what you're saying? Scotch and Stocks. Maybe you've been having too much Scotch. That's why I'm only getting half the sentence. But Yeah, I think a bigger draw overall. It is still supporting WTI crude at the moment. So it's been about 7 minutes. We still haven't seen a reversal of the trade. Again, data much more, bigger draw than expected overall. If we're comparing the API data, actually, that's a very, very good point of what I want to compare. So if there was, if there was a 4 million draw in the actual figure in API data, more or less, we can see that has coincided. So again, that showed that there was some correlation. Well, there was a correlation in the movement that the EIA Inventories data went with. So we had seen a draw yesterday of minus 4.496 million, and today we've seen a draw, or an even bigger draw, of minus 8.02 million. The gasoline, yeah, showed there was a build, so that was more or less in line with the API data. And distillate was a miss. So that had actually, well, yes, last night it was a build, but today it's showing a draw. But overall, the headline figure, it moved in line or in the same direction towards a draw. But as said, it's not. So as said, there isn't always a strong correlation, but as we can see here today, that has correlated quite well. And again, something to keep an eye out for API. All right, thank you very much for jumping on. I'm walking and listening. Sorry about that. Oh, okay. So we're still expecting inventories to go up for the upcoming future. Well, let's. I think with the crude oil inventories data, that's more. It depends on what the US does. I feel if they're looking to supply more oil, or if they already have been, or looking to supply some oil to Europe, and there's less oil in the US, there could be more of a draw in the EIA inventories later on in the future. The less oil that there is available in the US, so that could be a possibility. But if we're talking about reality and how much the US would pump or provide oil to other nations, in the wake of a loss in supply of commodities or energy from Russia, I don't think they would. This is opinion based, okay? So and part of it is what they've said as well. So in my opinion, I think the US hasn't really jumped into the oil market to provide oil to other nations. Okay, they may have released more oil reserves from the special reserve for themselves, but it doesn't mean, I think, overall, usually the more oil that is released, again, right, remember, that usually brings down prices. And we had comments about 3 weeks ago now when there was the headline that had said that the US is looking to potentially release oil from its reserves, or more oil from the SPR. Then we had seen a decline or depreciation in crude oil prices. But that doesn't really mean, does that coincide with the EIA inventories? Not always. I think, but this is something to be aware of though. So I don't think with the US releasing that oil, it's going to have too much of an effect of whether we get a huge build or huge draw, or whether we're expecting further draws within the release. So that's more up in the air. But yes, but again, there is a possibility we could get further draws if the US decides to release more oil to other nations, Europe, or let's say in particular Germany, who are heavily reliant on Russian energy. All right, so that concludes the live stream for you there. Thank you very much for jumping on. And we can see WTI is now up. Well, it was up by $1.34. Yeah, still up. It hasn't retraced. Hasn't gone back down to its pre-trading or pre-economic release level. Thanks for your professionalism, Tony. Thank you very much for FX Bears. I appreciate that comment. Thank you very much. That concludes Macro Race for this week. There are no other releases to have a focus on. I hope you've enjoyed that and you've found it useful. And it's if you have enjoyed it and you have found it useful, then as always, do hit me up on my email. Remember, you can also follow us on our Twitter page on Macro Ace, which is there, in which I've posted there in the text chat feed. But also don't forget to like and subscribe to Financial Juice on the YouTube channel that we're currently running on, and stay up to date with what we have coming up for next week. So next week is GDP data and also US consumer spending as well. So we'll be getting the advanced report next week. And of course, EIA Inventories again on the Wednesday. All right, thank you very much. Take care and goodbye.